Good morning, everyone. This tutorial is a follow-up to the lecture that we held the other time on audit risk. And we have to, by the end of this tutorial, finish solving the question we attempted to solve. So without wasting time, I'll just go through the question briefly, which question all of you are supposed to have copies of. And I'll also make the question available as a link at the bottom of the YouTube video. And please, you have to subscribe to the YouTube channel. Very important for you, not for me. Subscribe to the channel so that subsequent lectures and tutorials, you'll receive live alerts. So you are not, the semester is very short, so you need to get information and read them to get yourself prepared for the end of semester exam. Please, very important. Okay, so I'll get the question embedded with a YouTube video, as you see it at the bottom of the video as a link. I'll do that. And of course, you can also check the same question from the Google Classroom site. It's already there. So you can actually go through this tutorial with that question by your side. Let me go through the question quickly. I'll go through it again for the second time. We will be itemizing the issues that we are being required to solve. Before even reading the question, please let me read a requirement. The requirement says, identify and describe the matters in this case that give rise to audit risks in the audit of Perfect Paint. So you have that one at the back of your mind, and let's go through the question together. You are an audit senior in Santiago & Co., and you are commencing the planning of the audit of Perfect Paint Company for the year ending 31st December 2018. Forget about the year can be 2019 or even 2020. Perfect Paint Company is a paint manufacturer and has been trading for over 50 years. It operates from one central site, which includes the production facility, warehouse, and administrative offices. Perfect Paint sells all of its goods to large home improvement stores, with 60% of the goods being sold to one large store called Homewares. The company has a one-year contract to be the sole supplier of paint to Homewares. It secured that contract through significantly reducing prices and also extending a 4-month credit period instead of the company's normal credit period of 1 month. Subtopic: goods in, aka purchases. In recent years, Perfect Paint has reduced the level of goods directly manufactured and instead started to import paint from South Asia. Approximately 60% of the paint is imported and 40% manufactured in-house. Within the production facility is a large amount of old plants and equipment that is now redundant and has minimal scrap value. Purchase orders for overseas paint are made 6 months in advance, and goods can be in transit for up to 2 months. Perfect Paint accounts for the inventory, when it receives the goods. To avoid the disruption of a year-end inventory count, Perfect Pen has this year introduced a continuous or perpetual inventory counting system. The warehouse has been divided into 12 areas, and these are each to be counted once over the year. The counting team includes a member of the internal audit department and a warehouse staff member. The following procedures have been adopted for the count. The team prints the inventory quantities and descriptions from the system, and these records are then compared to the inventory physically present. Any discrepancies in relation to quantities are noted on the inventory sheets, including any items not listed on the sheets but present in the warehouse area. Any damaged or old items are noted and they are removed from the inventory sheets. The sheets are then passed to the finance department for adjustments to be made to the records when the count has finished. During the count, there will continue to be inventory movements with goods arriving and leaving the warehouse. At the year end, it is proposed that the inventory will be based on the underlying records. Traditionally, Perfect Paint has maintained an inventory provision based on 1% of the inventory value. But management feels that as inventory is being reviewed more regularly and through the perpetual inventory counting, it no longer needs this provision. So the provision is scrapped. Another subtopic, Finance Director. In September 2018, Perfect Paint had a dispute with its finance director, and the finance director immediately left the company. The company has temporarily asked the financial controller to take over the role while they recruit a permanent replacement. The old FD has notified Perfect Paint that he intends to sue for unfair dismissal. The company has not the company is not proposing to make any provision or disclosure for this, as they are confident the claim has no merit. Required, identify and describe the matters that give rise to audit risks in the audit of Perfect Paint company. So this is the first reading for the question. We can read it once more this time around, focusing more on the key issues that give rise to audit risk. The second reading is the phase where we begin to form our thoughts for what will constitute our answers. So this is like first quotes reading. Just to familiarize yourself with the case in general. And second reading, you can even do a third reading, all with the aim of planning your answers. That's very important for you to get maximum marks. So let's do it for the second time. Remember, the requirement is for us to identify issues, in this case, that give rise to audit risk. And all of us know what audit risk is. Audit risk is any issue, any event, any circumstances that can cause the accounts or the financial statements to be materially misstated. Any issue that can give indication that the accounts can be materially misstated. You flag it as a potential issue that can give. Remember, this is a planning stage thing. So you are not actually doing the work. You are kind of forming your mind, but this is a preliminary risk assessment. Preliminary risk assessment based on what is happening in the company that gives you a sense of what can go bad in terms of the accounts getting materially misstated. All right. So you need to kind of have that tuning of your mind. You need to have that kind of thinking at the back of your mind so that you can readily identify all the issues that could or that can represent material misstatement of the account. Okay, so let's read it for the last time. You are an audit senior in Santiago & Co. That's the audit firm. And you are commencing the planning of the audit of Perfect Paint Company. Perfect Paint Company is the audit client. For the year ended 31st December 2018, Perfect Paint Company is a paint manufacturer and has been trading for over 50 years. It operates from one central site, which includes the production facility, warehouse, and administration offices. Perfect Paint sells all of its goods to large home improvement stores, with 60% being sold to one large chain store. You see, just by this represents a huge risk. Selling 60% of your total goods to one store, if things happen to go bad for that one big store, then your whole company is going to rain down. In fact, your whole life will be revolving around this company. If that company collapses, that company collapses with you. But at this point, this is purely a business risk. And all you guys know what business risk is, different from audit risk. But to connect this to audit risk will mean that when this becomes the case, in case there's 60% company, what I mean is the company that we supply 60% of our goods to, if that company begins to have problems, which means we also begin to have problems, those problems may push us to kind of window dress the accounts for it to look good. Nobody wants to appear bad. Okay, so this is how this business risk can give an indication of a possible audit risk. And you remember that we learned that one of the key attributes or the key things that the auditor should be doing is to have what we call professional skepticism. Okay, so based on professional skepticism, if you have this as what the client company is facing, 60% of total goods is supplied to only one firm, then you can imagine that if that one firm begins to have problems, this other client will be in hot soup. And being in hot soup can push Perfect Paint Company, which is the other client, to be trying to window dress, to be trying to kind of go into what is described as creative accounting, try to to manufacture some figures to portray that the company is not bad, it's still doing well. Okay, so this is how this business risk can pose an audit risk. Let's continue with the reading. Remember, this second reading is kind of annotated reading, because this is where we are trying to form the thoughts which will form our answers. The company, I'm continuing the reading. The company has a 1-year contract to be the sole supplier of paint to homewares. And it secured this 1-year contract to be the sole supplier of paint to homewares through significantly reducing prices. And that's another thing you should flag. Significantly reducing prices. I'll come back and talk about it. And offering a 4-month credit period, even though the company's normal credit period is 1 month. So 2 issues here. Significantly reducing prices. When you significantly reduce prices, one thing is very obvious, which is are the goods, the prices at which you are selling the goods, are they no more the prices that customers are willing to buy? And remember, these prices usually are based on the cost at which you brought in the goods. So if customers now see the goods to be maybe outmoded or not, very expensive, and by that you have to heavily discount the prices, the added risk could be this. Is it not possible that by heavily discounting prices, the new prices at which you are selling the goods or some of the goods are even now below the cost at which you bought it? And it happens. For example, let's say you go and you are trading in tomatoes, and you know how perishable tomatoes can be. And business has not been very good. Business has been very slow. So you see most boxes of your tomatoes sitting idle. Customers are not coming to buy. Most of them have even started going bad. What will you do to save the situation? You will have to discount the prices. You have to reduce the prices significantly. And sometimes, in order not to incur total losses, you even sell them below the cost at which you bought them. Something is better than nothing. Reading this case, this can be the case. We are saying this can be the case because we are planning. We are now just forming our thinking of what can be happening in Perfect Paint based on the information we have. We don't know exactly what is happening yet, but based on professional skepticism and based on what we are identifying from the case, this is how we have to think. So by Perfect Company significantly reducing prices so that it can sell goods to a customer, does it mean that the company is even selling below its cost? And if the company is selling, if the significant reduction of the prices is now resulting in the fact that the new prices are below the cost of the inventory, then it is likely that Perfect Paint is accounting wrongly for inventory. Because once you realize, in business and based on the prudence concept largely, we do not have to deceive ourselves as business runners. Something that we know will not translate into a profit, why would we have to capture it as a profit? So if we know that, before, Perfect Paint going into this situation, Perfect Paint probably will have the understanding that, okay, this is how much I bought the goods and this is how much I want to sell them to make this how much margin. So those ones are already recognized in the books. If over time we come to the realization that the goods, the inventory that we have, no more sells for how much we intend to sell them, we need to write down the values of the inventory. If we come to the realization that, oh, how much we can even sell the inventory for is less than the cost, then according to International Accounting Standards number 2, we have to do this. If other standard says that inventory should be valued at the lower of cost and net realizable value. So we compare our cost and net realizable value, which is basically how much we can receive from selling the inventory. We use the lower of the two. So if the situation of Perfect Paint at this moment is that how much it is selling the goods because it has significantly reduced prices is now lower than the cost, then it needs to go back and rewrite the values of the inventory to reflect that situation. So now the values of the inventory should be carried at the net realizable value and no more the cost, because the cost is higher than the net realizable value. And you have to be able to flag this, because it is very possible that they are not thinking the way we are thinking right now. And they are not doing that. They have not rewritten the values of the inventory to reflect what IAS 2 is saying. And that inventories are still carried at cost, even though the cost is far higher than the net realizable value. Okay, so the second issue in this highlighted, first yellow highlight. Second issue there is that apart from significantly reducing prices, they also extend credits to 4 months instead of 1 month. Okay. So how is this an audit risk? If your official credit policy is to give 1 month credit period, what happened that now you have to give 4 months? Is it because now you, from your trading records, you can see that customers are not able to pay within 1 month, which is a signal of uncredit worthiness of customers? And if your solution to that problem is by extending more credit period, then the risk is that more of your receivables may be incollectible or uncollectible. You drag the company into the issue of higher possible bad debt. And in the case, there is no indication anywhere that Perfect Paint is going to really deal with this issue of extended credits beyond the official credits policy by making provision for doubtful debts. There's nothing like that. And if there's nothing like that, then receivables will be carried at a deceiving value, deceiving in quotes. We might deceive ourselves to think that, or Perfect Paint will deceive itself to think that all the receivables that it has recorded are actually receivables, only to realize at the end of the day that some of them may not be collectible. So you make provisions for that based on the situation. There's no provision. So the fact that there's no provision will show will show higher receivable, which is not realistic, and that is a misstatement. That is an audit risk. Okay. Goods in, also known as purchases. In recent years, Perfect Paint has reduced the level of goods directly manufactured and instead started to import from South Asia. Approximately 60% of its the goods are imported and 40% manufactured. Well, we can see some business risk with this kind of approach. Number one may be that now you may not have that control over your own goods, someone else is doing it. Maybe they have a good reason for doing that. Maybe, manufacturing it in-house is more costly. If they buy from outside, that is better. Fine, but there's also the risk that since you don't have control over your own manufacturing, anything that goes bad there affects you as well. But that is a business risk. So let's continue. Within the production facility is a large amount of old plant and equipment that is now redundant and has minimal scrap value. Right. So how does this reflect audit risk? I have highlighted a 0 because I saw some audit risk associated with that. So what do you see as the audit risk? So this is how it is, an audit risk. It is very likely that these old plants and equipment, which are redundant and has minimal scrap value, are still being carried at their book values. It's likely. Even though from the case, we are being alerted to the fact that these plant and equipment have minimal scrap value. Scrap value is when we sell it now, what we can recover. And if we read IAS 16, which is about property, plant, and equipment, and IAS 39 talks about impairment of assets. So if these abandoned or redundant assets have minimal scrap value, which may be below the carrying amounts, then Perfect Pens needs to rewrite the values of these assets to reflect the fact that what we can get from them or the value of these assets is no more the carrying amount, but the scrap value. IAS 16 and IAS 39 requires that these plant and equipment are valued at the lower of carrying amounts and recoverable amount. Recoverable amount is the scrap value at the lower of the two. And it is quite clear that the values, the recoverable amount of these redundant assets will be far lower than the carrying amount in the books. And it is likely that Perfect Paint has not made any adjustment to the values of these assets, and that the values of these redundant assets are still being carried at the carrying amount and not the recoverable amount. If that is the case, then the accounts are wrong. Making the values, writing the values this way instead of that way makes it wrong. And that is another risk. That is a risk of material misstatement. Let's continue. Purchase orders for overseas paints are made 6 months in advance, and goods can be in transit for up to 2 months. Perfect Paint accounts for the inventory when it receives the goods. Okay. So this is the case because we order the goods overseas, and goods can be in transit for a lengthy period, up to 2 months. We are going to have cut-off problems. Cutoff of purchases and inventory may not be accurate. At the year end, goods purchased but still in transit will not be captured as part of purchases and inventory in the year. And you have to know this, the matching concept. The matching concept says that all the dealings of a business that happens in a particular year all of them should be accounted in that year. We should not kind of shift part of the transactions across periods. That's bad. That is mismatching. Okay, and because of this overseas ordering and the fact that goods can be in transit for up to 2 months, let's say we ordered goods in December 1st, December 1st, 2018. Those goods, once the contract to order them is sealed, are purchases and they are inventory belonging to 2018. But if you look at what happens in Perfect Paint, goods can be in transit for about 2 months, which means that December 1st, December will end 1 whole month, the goods will not be in. And January ending is when the goods will be in. January ending will be January the next year, 2019, which is another accounting year. And what makes it a big issue is that Perfect Paint accounts for the inventory when it receives the goods. So you can imagine that we're going to have a huge cutoff problem. And this will make the accounts wrong. Purchases that belong to 2018 may shift to 2019 and so on and so forth. These will be wrong accounts, and this is a risk of material misstatement audit risk in that respect. To avoid the disruption of a year-end inventory count, Perfect Paint has this year introduced a continuous or perpetual inventory counting system. Okay, so let me talk about it, how it may feature as an audit risk. The fact that there is a new system is newly introduced, has its own risk. Staff may not be on top of issues regarding this new system. And there is always some element of errors. Staff trying to actually be on top of newly implemented systems. And these errors in aggregate, if not in isolation, can be material, which can get the accounts wrong. New inventory counting system, we have not done it before. People are going to do it for the first time. They are now going to learn how the system works and should work through doing. They'll make few mistakes. These mistakes can get the accounts wrong materially. That's how it can become another risk. The warehouse has been divided into 12 areas, and these are each to be counted once over the years. And this one can also bring in some element of audit risk. The fact that the warehouse is divided into 12, it is possible that we can count one area twice. Possible. We are talking about possibilities, please. We are not saying this is what is actually happening. But based on the information, we are just thinking of what can happen as a mistake, as an error, as fraud that can make the accounts go bad. We are being professional, skeptical. So dividing the warehouse area into 12 zones of 12 areas, we count here. When we finish, we go and count another place. It is very possible that we can count one area twice. It's also very possible that we can skip some areas. And when that happens, the inventory values will be wrong, and these will be carried in the accounts, and the accounts will be wrong. The accounts can be materially misstated. Audit risk. The following procedures have been adopted. The team prints the inventory quantities and descriptions from the system, and these records are then compared to the inventory physically present. Any discrepancies in relation to quantities are noted on the inventory sheets, including any items not listed on the sheets but present in the warehouse area. Any damaged or old items are noted and they are removed from the inventory sheet. Please, you will say something about these damaged or old items of inventory as part of audit risk. All right, just reason around why that can be something we need to pay attention to. I'm just giving you about 1 or 2 minutes. Okay, so for large manufacturing firms, it's almost always the case that some items of inventories can go bad, they can get damaged, and we can have some items of inventory over sitting in the warehouse going old and obsolete. These are part of business. They are normal part of business, which means that it is something that we need to provide for because it's normal with us, right? Because we know it is normal that it will rain and shine. That's why we make structures to shelve ourselves. Because it is normal that items of inventory can be obsolete and they can get damaged, it is also a normal business practice to make provisions for this kind of thing. And as we move along, you realize that Perfect Pen was doing it, and along the line it stopped. And once it has stopped, it is not going to actually portray, the account is not going to portray the reality, the true issues, right? So that's what I wanted you to be aware of. We'll talk about it later. So let's move on. The sheets are then passed on to finance department for adjustments to be made to the records when the accounting is finished. During the count, there will continue to be inventory movement with goods arriving and goods leaving the warehouse. I mean, this is clear. This can make the accounts go bad. We are counting inventory. At the same time, we are counting goods are coming in, goods are leaving. This will complicate the count. Already, we have said that this counting system is even new, and the fact that it is new and people are struggling to learn it will produce errors. Compounded, that problem compounded by the fact that when the counting is going on, goods in large quantities are coming in, others are going. The counting will go wrong. Counting is most likely to go wrong, and that the figures that will report at the end of the counting and put in the accounts as the value of inventory can be very wrong. It can be different from the reality, and the account will be misstated, audit risk. So let's continue. At the year end, it is proposed that the inventory will be based on the underlying records. Okay, so this one is just buttressing the fact that the inventory values are most likely to be wrong, because with all these complications, they just use whatever the system produces as the inventory values. That's what Perfect Paint actually will take as the inventory value and put in the accounts. Traditionally, Perfect Paint has maintained an inventory provision. So remember, I was earlier talking to you about provision for damage old inventory. Because it's a normal business practice that these things happen. Inventory can go bad, inventory can be obsolete. We make provisions for that. And that is exactly what Perfect Paint was doing. Perfect Paint has maintained an inventory provision based on 1% of the inventory value previously. But now management feels that because they have introduced the so-called perpetual or continuous inventory counting system, it no more longer needs to make this provision. And is it really true? No. So the stopping of providing for what is a normal part of business, inventory going old, inventory going bad, the stopping of making provision for such a normal event in business will make the account not reflect the reality. In that case, the account will be misstated. Audit risk. Finance Director. In September 2018, Perfect Paint had a dispute with its finance director, and he immediately left the company. The company has temporarily asked the financial controller to take over the role while they recruit a permanent replacement. How is this an audit risk? Well, FD has left. FD's position is quite bigger, and it requires a lot of experience, training, exposure, skill than financial controller. Financial controller reports to the FD. Right. So the exit of the FD and the decision by Perfect Paint to temporarily replace the FD with the financial controller, because the financial controller may not have the same level of skill, experience, training as the FD, the financial controller occupying or doing the work of the FD, he can produce some mistakes, can make some errors. And these errors could make the accounts materially misstated. Yes, that's one way you can see it as another risk because of what is happening. Second, they said the financial controller is temporarily taking charge of the FD's position while they recruit permanent replacement. The recruitment of a new FD also comes with another risk. New FD may have to take some time to familiarize himself or herself with the company culture, exactly the way this Perfect Paint does it, things, blah, blah, blah. So for at least in the meantime, the FD going through the learning curve can also work with some mistakes. And in aggregate, these mistakes can constitute a material misstatement in the accounts, and therefore audit risk. Okay. The old FD who is gone, who is sacked from the company, has notified Perfect Paint that he intends to sue Perfect Paint for unfair dismissal. Perfect Paint is not proposing to make any provision or disclosure for this, as they are confident that the case will go nowhere. How is this another risk? How is it another risk? Audit risk because the accounts, the way we see it, is most likely to be deficient of provision for contingent liability, or at least a disclosure of it. The intention of the former FD to sue for unfair dismissal creates a contingent liability. And we all know what contingent liability is from your financial reporting studies. That is IAS 37, yes, I think so. IAS 37 talks about provisions, contingent liabilities, and contingent assets. And it says that if there is a present obligation and a probable outflow of resources to settle the obligation, and that a reliable estimate can be made of such an obligation, then a provision should be recognized in the financial statement. It is something that we envisage will happen. And when it happens, it will cause an outflow of resources. And this liability can be estimated to some good, can be reliably estimated to some good level. Okay, then it's a good thing to make provisions. Make provision for it. The FD has sued, or he intends to sue. If he sues and we lose the case, we may have to pay damages to the FD. And if you can get a sense of, and of course we can, I mean, Perfect Pen can do that, a sense of, I mean, probably it might have even had a case like that, so it can gauge what the likely liability is, I mean, will be in terms of amount. If it doesn't have a case by itself, it can learn from what has happened to other companies. So this is not an information Perfect Pen cannot get. And Perfect Pen can get a good sense of what the amounts, in case they lose the case, is likely to be, and therefore they have to make provision for that. You have to recognize contingent liability. Provision for contingent liability in the accounts. If the estimation, I mean, if the likelihood is assessed to be remote, or the amount involved is not readily and reliably determinable, then the same standard is recommending that at least you make a disclosure in the account. If you cannot make, I mean, come out with figures which will go to affect the account, at least you need to disclose it, that this is what is happening, for users of the accounts to be aware of exactly what the situation is. And that's full disclosure. The accounts being deficient of this will not make the accounts complete. And therefore, the accounts can be said to be misstated in some way, and therefore audit risk. All right. Okay, so this is where we bring the discussion to a close. What I've done is kind of attached these commentaries I have just done to the case. So I've made comments to the case to guide your easy understanding of it. And this is just how I want you to think about answering audit risk questions. That's why I've taken my time to do this video and also do the annotations to the case itself. So I'll send the annotated case on the platform. And of course, you're also going to have this video uploaded on your YouTube channel. So do well to subscribe for your own good, please. And also for the fact that subsequent videos, you can get ready alerts. Okay. So thank you very much for your time.